Welcome to vTalkInsight, Market Drivers Daily for March 6, 2026. Gulf tensions and an energy shock are now colliding with sticky inflation and strained supply chains, forcing a fresh look at how risk is priced across assets. Geopolitical tension around Iran and the Gulf has shifted from background noise to the dominant macro driver. The near halt in traffic through the Strait of Hormuz, alongside a surge in oil prices toward and above $90, has turned what began as a regional flashpoint into a potential stagflation scare. In recent days, missile and drone exchanges across multiple Middle Eastern countries, including strikes on energy infrastructure, have pushed crude to its largest weekly gain since 2022. Brent has traded in the high 80s to low 90s, WTI in the mid-80s, and energy stocks are the clear outperformers while most other sectors trade lower. Shipping through Hormuz, which normally carries around 1/5 of global oil and liquefied natural gas, has been slashed. Vessel counts have reportedly fallen from roughly 40 ships a day to almost none, underscoring the scale of the disruption. Washington is leaning on political risk insurance for tankers and targeted waivers that allow Indian refiners to keep importing some Russian barrels in an effort to maintain minimum flows. Yet there is still hesitation to tap the Strategic Petroleum Reserve, signaling limited political appetite to use that tool unless the crisis drags on. Across markets, this shock is raising risk premia rather than delivering a textbook flight to quality. S&P and NASDAQ futures are under pressure. Volatility indices have pushed toward the mid-20s, and many investors are actively cutting portfolio beta and trimming credit exposure. Traditional safe havens like the yen, the Swiss franc, and even parts of the G4 government bond complex have not offered much protection, as yields rise alongside inflation expectations. Instead, the U.S. dollar and high-quality U.S. corporates with strong balance sheets and clear capex plans are emerging as preferred relative refuges. The macro debate now pivots on how long oil stays elevated. Sustained prices above $80 are associated with slower U.S. growth, and recession risks rise if levels above 100 or even 120 persist for an extended period. Globally, a prolonged 10% rise in energy costs could lift inflation by up to around 0.7 percentage points and shave roughly 0.4 from growth, with Europe highlighted as especially exposed. Rate markets have responded by sharply reducing the odds of Federal Reserve and European Central Bank cuts this year, and in Europe even flirting with the possibility of renewed hikes as energy-driven inflation expectations move higher. There is, however, a strong counter-narrative that treats this as an inflationary bump rather than a lasting regime change. Crude remains below the most extreme crisis levels. Inventories and spare capacity provide some cushion. Europe has diversified gas supply since 2022, and China has accumulated substantial oil stockpiles. Forecasts that see Brent drifting back toward the mid-60s by year-end rest on the idea that disruptions prove temporary and that markets adapt through rerouting and demand adjustment. The risk is that pricing still leans too heavily on a quick de-escalation scenario. If Hormuz remains constrained for several more weeks, or if attacks broaden to NATO-linked assets, oil could test triple digits and risk assets may face another leg down. The key watch points are tanker and container traffic through the Gulf, any shift in U.S. policy on reserve releases or sanctions waivers, and signs of diplomatic traction. Those same factors will heavily influence how far the shock spreads into global supply chains. Beyond headline moves in crude, the conflict is increasingly transmitting through supply chains. The closure of key sea lanes and air corridors in the Gulf, layered on top of existing bottlenecks in technology and energy, is turning logistics into a second, slower-burning shock for production, margins, and trade. Earlier this week, we highlighted that supply routes were under strain. Now the picture is more severe, with multiple transport modes simultaneously disrupted. Tanker and container flows around the Strait of Hormuz have dropped to a fraction of normal. Vessel counts have fallen from roughly 40 ships a day to almost none, and around 100 container vessels are reportedly stranded or being rerouted. Major shipping lines such as Maersk and Hapag-Lloyd have suspended services into parts of the Persian Gulf, while container and air cargo routes between the Middle East, Asia, and Europe are effectively at a standstill. Air freight rates from Asia to the Gulf and Europe are already 10 to 20% higher, and war risk insurance premiums have pushed some tanker day rates in the region toward $1,500. Energy product markets are feeling the strain first because roughly one-fifth of global seaborne oil and gas normally transits Hormuz. Shutdowns there have forced refinery cutbacks and prompted Japanese refiners to request strategic stock releases as a precaution. In Asia, Singapore jet fuel has jumped above $200 a barrel and, in some accounts, closer to $250, while China has instructed some refiners to curb exports and prioritize domestic needs. Buyers outside China, including Taiwan and Southeast Asia, therefore face both higher prices and tighter availability, whereas South Korea's more diversified sourcing offers relatively greater resilience. The technology complex faces a different but related squeeze driven by AI demand. Strong appetite for AI computing is creating significant shortages in memory chips, with memory now estimated to represent around 40% of smartphone build costs, up from about 15% a year ago. Analysts expect the global smartphone market to contract by roughly 13%, and they do not see the memory imbalance resolving fully until 2027. At the same time, draft U.S. policy on AI chip export controls, potentially extending to dozens of countries, has weighed on names like NVIDIA and AMD and injected new uncertainty into the build-out of global AI infrastructure. Policy responses are starting to rewire some of these chains. In the United States, bipartisan efforts to reinforce munitions, medical, and critical mineral capacity point to more onshoring over time, while Europe is leaning further into liquefied natural gas imports from the U.S. and Norway to reduce residual dependence on Russian supply. The waiver allowing India to import Russian crude offers short-term relief for Indian refiners and supports Russian fiscal flows, while airlines such as Lufthansa are planning to expand long-haul routes that bypass disrupted Middle Eastern hubs. For markets, this implies greater dispersion. Logistics providers and select energy and defense names may benefit from elevated volumes, but airlines with limited fuel hedging, retailers exposed to tariff and freight costs, and smartphone manufacturers squeezed by component inflation all face rising earnings and credit risk. The counterpoint is that past transport shocks have often proved temporary as ships reroute and inventories adjust. Some tankers are already reflagging under Chinese or Russian ownership to mitigate perceived targeting risk, and alternative export routes via ports like Yanbu offer at least partial relief. The duration of Gulf shipping suspensions, the path of freight and insurance prices, and the tone of upcoming corporate guidance will show whether this benign view holds, and will shape how strongly today's logistics shock feeds into the broader inflation narrative. The third strand of today's story is inflation. The energy shock is feeding directly into prices at the pump and beyond, complicating central bank plans for rate cuts and reviving concerns that the disinflation process may stall or even reverse into a stagflation backdrop. In the United States, gasoline prices have risen roughly 20 to 25 cents per gallon in just a week and almost 50 cents over the past month, taking them to an 18-month high and close to the $4 psychological threshold. Brent and WTI crude are trading near or above 90 and the high 80s respectively after a year-to-date rise of about 20%, and jet fuel benchmarks in Asia and elsewhere have spiked even more, in some cases trading above crude. European energy prices are also climbing again as the Middle East conflict tightens global supply. Economists expect these moves to lift March headline inflation, with estimates that higher gasoline alone could add 30 to 40 basis points to consumer price indices. In Europe, a sustained 10% increase in energy prices might add around 40 basis points to inflation. The bigger issue for central banks is whether these shocks remain confined to headline prints or bleed into the core. Services inflation, particularly in healthcare, remains stubborn, and the latest U.S. wage data showed average hourly earnings rising 0.4% month-on-month and 3.8% year-on-year, both above expectations. Break-even inflation rates have moved higher, and government bond yields have risen, signaling that markets are starting to question the path back to 2% targets. Rate expectations have adjusted quickly, with markets now seeing persistent inflation amplified by oil as the main risk for equities and paring back the number and timing of expected Federal Reserve and European central bank cuts. Some pricing even entertains the possibility of additional tightening in Europe, while scenarios that link oil above $80, $100, or $120 to progressively weaker growth are fueling renewed stagflation concerns. On the ground, higher fuel and commodity prices are squeezing consumers whose savings buffers are thinner than in prior years. Recent U.S. retail sales data shows softness in discretionary categories such as dining and sporting goods, and there is concern that ongoing tariff and energy shocks could erode disposable income further. Rising pump prices are also becoming a political issue, with discussion of measures ranging from regulatory easing to possible releases from strategic reserves, even though analysts doubt these tools can fully offset a geopolitically driven supply shock. Central banks are signaling a preference to wait and assess the persistence of the shock rather than react to each monthly print. Balancing this, some policymakers and analysts continue to stress the potential temporariness of the current energy spike. They argue that if the conflict stabilizes and oil retreats, headline inflation should ease back, productivity gains could reassert downward pressure on unit labor costs, and the broader disinflation trend may resume, albeit from a higher starting point. Forecasts that see Brent drifting back into the 60s by year and assume ample spare capacity and a relatively quick adaptation of supply chains. For now, the key watch points are the composition of upcoming PCE and CPI releases, especially the split between goods and services, the trajectory of wage growth, and the evolution of inflation expectations. Together with developments in the Gulf and in global shipping, those data will determine whether this episode remains an uncomfortable bump in the road or hardens into a more persistent inflation regime. Across geopolitics, supply chains, and inflation, the common thread is duration risk. The longer Gulf disruptions and elevated energy prices persist, the greater the pressure on growth, earnings, and the rate outlook. Markets are already repricing cuts from central banks and rotating toward perceived quality, but are still implicitly betting on a relatively short-lived conflict and a retreat in oil. Watching tanker and freight flows, upcoming inflation releases, and policy signals around strategic reserves and export controls will be critical for gauging whether this remains an inflationary bump or evolves into something closer to stagflation. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.